Thank you very much again for joining me once again on this very important session of financial instruments. In the previous video, we introduced classification as well as measurement of financial instrument. I wish to pick it up again from there. Before us, we've got offsetting financial assets and financial liabilities. What does the standard say? A financial asset and a financial liability are required to be offset or presented as a single net amount when the entity has a legally enforceable right to do so, and also B says intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. Otherwise, financial assets and financial liabilities are presented separately, just like we have general guidance under IS 1. Embedded derivatives. Some contracts that may or may not be financial instruments themselves may have derivatives embedded in them. Ordinarily, derivatives not used for hedging are treated as held for trading and measured at fair value through the profit or loss. Let's now focus on another key aspect in our discussion, which is the issue of impairment. I'm just going to give a brief discussion over the issue of impairment, and then I'm going to go back and try to again reinforce the views under the issue of measurement of financial instruments. Let us look at some key terms. Credit loss. What is a credit loss? Well, a credit loss is simply the difference between all contractual cash flows that are due to an entity and all the cash flows that the entity expects to receive discounted. Well, credit losses are very much prevalent in the financial sector, all right, where we give out credit as our products to our, let's say, loan clients, and there's a chance that those loan clients may not pay. Expected credit losses. This is the weighted average of credit losses with the respective risks of a default occurring as the weights. Then we have got lifetime. This is expected credit losses. The expected credit losses that result from all possible default events over the expected life of a financial instrument. Then we've got past due. Past due. A financial asset is past due when a counterparty has failed to make a payment when that payment was contractually due. Then we have got what we call 12 months expected credit losses. This is the portion of the lifetime expected credit losses that represents the expected credit losses that result from default events on the financial instrument that are possible within the 12 months after reporting date. All right. What else do we have? IFRS 9 uses an expected loss model. An expected loss model means that the financial statements should reflect the general pattern of deterioration or improvement in the credit quality of financial assets from the date of initial recognition based on changes in expectations. That is reperformance of the borrower or external credit rating. Recognizing an allowance even before a credit loss has objectively arisen. This is a forward-looking impairment model. Credit losses should be recognized in 3 stages. What are those 3 stages? All right, so we have got when. That is stage 1. Initial recognition. At stage 1, we have the following. So I'll be going down. When under initial recognition should be made on 12-month expected credit losses and the calculation of effective interest on the gross carrying amount. We're going to do a question very soon that discusses all this. In stage 2, credit risk increases significantly, and this is assumed after 30 days past due. So again, recognition, you recognize based on lifetime expected credit losses, and the calculation is based again on the gross carrying amount. Next, stage 3, we have now what we call objective evidence of impairment existing at reporting date. This could be due to, let's say, A customer, let's say, going out of business. Recognition, again, you use the lifetime expected credit losses. Then the calculation is on the carrying amount net of any allowance for credit losses. All right. So let us start by reminding each other about what we have done under measurement, and then we shall go to the issue of impairment of financial instrument. Let me go to a question. We are told in this, we are just from doing Wharton. Let's go to Johnson. Johnson, an investment property company, adopts the fair value model to measure its investment properties. The fair value of the investment properties is highly dependent on interest rates. The finance director of Johnson has requested your advice on accounting for the following financial instruments transaction which took place in the year ended 31st December 20x1. Of course, the requirement is that we should discuss with suitable calculations how the above financial instruments should be accounted for in the statements of Johnson for the year ended 31st December 20x1. A says on 31st December 20x1, Johnson took out a 9 million bank loan specifically to finance the purchase of some new investment properties. Fixed interest at the market rate of 5% is charged for the 10-year term of the loan. Transaction cost of 150 were incurred. So this is an example of a financial liability. How do we progress to measure this type of liability? So again, we go there, we do some bit of work. Let me have my dollar sign there in advance. I'd like to just work this one out simply and briefly. Please, if you've got a pen, you can write the following. I'll be typing as well. A bank loan, let's go there. When you look at the question, a bank loan should be initially measured at fair value. Should be initially measured at fair value. That's your first point. All right, less any transaction costs. All right, and subsequently amortized at costs. That's what we do. So in the case above, what do we have? We have a financial liability. In our case, we have a financial liability of 850,000 dollars. There's a working that I'm going to do just now, so that you understand how that is coming about. It's coming about as a result of doing this minus the cost, transaction cost of that much. So that's what we have there. All right. Subsequent measurement, please, if you're writing, you can write. Subsequent measurement would then be amortized at cost. An effective interest rate would be calculated to include 5% interest as well as 150 transaction cost. This interest would be recognized as an expense in the profit or loss for the year ended 31st December. All right. The finance cost, further instructions, can be measured at fair value through profit or loss to promote consistency. Now, this view is in support, or is supported by the fact that Property is usually measured at fair value. And then now we can also add the following point. If the fair value option is chosen, the loan will be measured at 900,000 with 150 recognized immediately in the profit or loss. Any gains or losses arising on the loan should be registered in the profit or loss. So that is how you handle this part, which I call part A of that question. Let's now go to part B. In part B, what do we have? Like us to go back to the question and read carefully. On 1st November X1, Johnson took out a speculative forward contract to buy coffee beans for delivery on 30th April 20X2 at an agreed price of $6,000, intending to settle net in cash. Alright, so you lock yourself in a forward contract of $6,000. Now, due to a surge in expected supply, a forward contract for delivery on 30th April would have cost $5,000, meaning that there's a loss here that we're incurring, and that loss must be treated as a financial liability. Alright, must be treated as a financial liability. So whenever you have got a forward contract that results in a loss, then you are dealing with a financial liability. Please do not forget that point. So how do we progress to do the work? Nice one. If you have got a pen again, you can start writing, please. The forward contract not held for delivery of the entity's rather expected physical purchase or usage requirement or and not for hedging purposes is to be recognized at fair value or accounted for at fair value. At inception, the fair value of forward contract is of course 0. Remember that contracts, these instruments do not involve any amounts in most cases. But at the end, the fair value can still be established of this particular financial instrument. So what do we have? At the end, we have the following scenario. There is, let me just put my $sign there. You have got a fair value. You have got a market price rather. Let me write market price of forward contract standing at 5,000, and then you have got your locked forward contract standing at about 6,000. So we agreed, to pay 6,000, but due to reduction in price of the commodity, we could have paid about 5,000. So what we have here is a loss of about 1,000. All right. So if that is the case, remember we are dealing with a financial liability of 1,000. So the financial liability of $1,000, all right, must be recognized in the statements, okay, as follows. How do we proceed? Nice. We say debit profit or loss with the same 1,000, and then credit financial liability with a 1,000. That's how you proceed. So we are done with that question. I would like us to proceed to another question. This is now dealing with impairment. Assignment 3, impairments. Impairment of financial instruments. On 1st January 20X5, ABC Bank made loans of 10 million to a group of customers with similar credit risk. Allow me to go to the requirement. It says discuss with suitable calculations the accounting treatment of the loans for the year ended 31st December 20X5. Again, if you're due in the banking sector, you can't run away from the animal they call credit risk, the risk that a particular client may not be able to pay for their debts. So we are told on 1st January X5, ABC Company made loans of 10 million to a group of customers with similar credit risk. Interest payable by the customers on these loans is LIBOR, which is the basic interest rate at 2% reset annually. On 1st January 20X5, the initial present value of expected losses over the life of the loans was 500,000, using a discount factor, of course, of 3%. And discount factors, of course, just simply shows us how much money we're losing as a result of having this irrecoverable debts. The probability of default over the next 12 months was estimated at 1st January 20X5 to be 15%. Customers pay installments annually in arrears. Cash of 400,000, including interest, was received from customers during the year ended 31st December 20X5. The LIBOR rate for the year ended 31st December was 1.8. After the loans were advanced, the country entered into what we call an economic recession. This is one of the most feared things in any nation. By 31st December 20X5, the directors believed that there was objective evidence of impairment due to the late payment by some of the customers. The present value of lifetime expected credit losses is now to be revised to 800,000. Required, discuss with suitable calculations the accounting treatment of the loans for the year. Again, LIBOR means London Interbank Offered Rates. It's the basic rate of borrowing. All right, so let us do the work and then we shall close. This is impairment of financial assets. In this case, this is credit advanced to our clients. All right, so let's do some bit of work here. I want to begin by discussing, and I think this one requires a little bit of some work. So, if you may, I'll be typing some of the things that I'm saying. Some things I'll be saying, some things I'll be typing, so it's better to use a pen, please. This is lecturing, this is not teaching. I believe in training. Now you can write, you can say, on 1st January, ABC Bank should recognize an allowance for credit losses of the following. So you write the following. On 1st January, ABC should recognize an allowance of. So now we need to be retracting back to the question as we are doing this work so that we understand. Of 75,000. Why 75,000? Open brackets, and then we are told that the opening amount expected not to be collected is standing at 500. Let me just get that before they hang me. What are they saying? There's a sentence here. The initial present value of expected losses over the life of the loans was 500,000. So what you do, you get that same 500,000 and apply the default rate. So we initially had a default rate of 15%, which is, please, you can confirm this at your own time. Okay, so the above is, you can write this, 12 months expected credit losses, 12 months expected credit losses, 12 months expected credit losses. We can also write the following, say corresponding expense of 75,000 should be recognized in the profit or loss. So recognize, remember that one was a credit entry, a corresponding expense of, again we're dealing with 75,000 in the statement of profit or loss. All right, there we go. Next, what do we have? During the year, and remember as I go with the allowance will of course be set off against the loan asset in the statement of financial position, that same 75. During the year ended X5, an interest cost of that much must be recognized. Again, this interest cost is a representation of amounts lost on these assets as a result of not converting the asset into cash. So please let us recognize that. So we write following another point: during the year an interest expense of, I write my figure there is 2250, should be recognized. Where am I getting this? Again, I'm getting this from the figures. What was the figure there that we are seeing? All right, let me write a 3 and then we write a percentage there. That's what I have there. The interest expense will increase your allowance, and it also increase the expense in the profit or loss. Please let us remember that. Interest revenue, now let's get to that. Remember, this is a financial asset. Interest revenue of 380 should be recognized based on, according to the rules, the gross amount of these assets at the beginning of the year. So you write again, interest revenue, let me just write that one, of interest revenue of 380. Where am I getting this figure? Again, I'll demonstrate working brackets. We have got a 10 million loan. Let me just write that one. 10 million loan multiplied by the basic rate of 2 plus the closing rate of 1.8. How much are we getting? 2 plus 1.8, of course, that is 3.8%. So that's how I'm getting that figure. Should be recognized in the profit or loss for the year ended 31st December. This is calculated on the gross CV of the 10 million. Again, I hope that is clear. All right, I hope that is clear. So now the next work we have to do is to carry out a working of some kind in order to establish how much we are going to have at the end of the year for this particular receivable. Now, of course, this is very important, of course, for some of you who are going to hold senior position in finance, how to establish carrying amount of an impaired financial asset. Let's go to that. Say at the end of the year we have a figure that we opened with 1st January X5. How much did we open with? We opened with a gross amount, of course, of 10 million. All right, this is not supposed to be very difficult. And to that there is an addition. Add your interest income, which we have found, say 10 million. I do that again, 10 million by 3.8%. We were getting a 380. I hope that you're seeing that. Next, then we had less the payments that have been made so far by our clients, excuse me. So that's what we have there. If I less this amount, How much am I having? Let me just put, all right, let me now establish how much I have at 31st December x5. What do we have? What do we have? Let me sum up. That is the amount that we have there. So this is the amount that we're supposed to run with at the end of the year. Now we put in additional points. However, by 31st December, due to recession, the existence of objective evidence is kicking in now in the form of late payment by customers. By now, we have reached an advanced stage in recognition of impairment arising on this particular financial instrument. The revised lifetime expected credit losses of 800 should now be recognized in full. The allowance should be increased, of course, from 75 rather to 77 to 50. Remember, the 2 to 50 was resulting from interest expense based on our 3%. We need to now make some kind of a adjustment to our allowance. So let us do some bit of work. So during the year, what happened? We had the following. Brought forward allowance was, of course, calculated as 75,000. Then the interest expense based on 3% was, of course, again calculated to 250. Now we have been told that we need to revise this amount to 800. All right, it's actually supposed to be 80,000. Let me just check that one. How much do we have? Okay, so it is 800. That is fine. Let me again go back and look at that. So what do we have there? We have got 800, which will result in an extra charge of 240. Let me right, let us continue. So we need now to check for the question again. How much is the closing default rate? The present value of the lifetime expected credit losses was revised to 800,000. The expected default rate is now standing at 10%. So what we do is we get back there the closing allowance. Let me just do that. Wait for that. All right, all right, thank you. So we have got closing allowance will therefore be, let's bring it here, 80,000. And when you do your maths, what will be the increase in the allowance? We get the difference between that figure minus those figures. Let me just do it again. We say equal sign this figure minus that figure minus that figure. That is the figure that I was looking for. All right, so if you've got a pen, you can write following. You say the allowance should be increased from the combination of 75,000 plus 2 to 50 to 80,000. 8,000, which will result in an extra charge of 2,750 in the statement of profit or loss. In the year ended 31st December X6 stage 3 could have been reached, interest revenue will be calculated on the carrying amount of the allowance for credit losses. All right, and the carrying amount of the allowance, again, you can write, if you've got a pen, you say 9980,000 minus 800,000. That gives you 9180. 9180. Conversely, if the loans were still on stage 1 and 2, interest income and the interest cost would be calculated on the gross carrying amounts of 980 and 800 respectively. So this is how we're supposed to do that work. I'm going to end there for now. Let us go through this question and come up with questions. Thank you very much for your attention.